or it need not be something always which comes from what you call as monetary benefit. Now, whenever we are talking about venture capital, yes. Now, whenever we are talking about venture capital, one second. Yes. Whenever we are talking about venture capital uh, is a concept which is gaining importance these days because it is typically allocating funds to small companies which have some exceptional growth perspectives or which can grow very quickly, right? Or which have a continuity to expand very quickly. For such kind of funds, venture capital funds are provided. It will give you a qualities, or it will give you a combination of banker, it will give you a quality of stock market investor, or it can also give you a quality of an entrepreneur. That is in these three main features of all these banker, stock market investor, or an entrepreneur. When combined together, we can get the services of something called as venture capital. Now, whenever we are talking about venture capital funds are something which comes with, or which has many features. For example, venture capital funds have high degree of risk. They represent financial investment, or they represent financial instruments which are highly risky, right? Because we have learned, when the amount of risk involved in a project is high, the amount of return involved in such kind of projects is also very high. So those are high risk projects, and they have something called as equity participation. Venture capital financing is actually a participation into an equity firm, where the objective of venture capitalist is to make some capital gains, or is to make some gain by selling the shares once the firms become profitable, or once the firms become what do you call as high earning firms. Not only that, venture capital financing gives you something called as long term investment, right? Venture capital financing is not for short term, it is a long term investment opportunity. It generally takes a long period of time to encash your investments if you're investing them in venture capital. Not only that, it gives you something called as participation in management. In addition to providing capital, venture capital will also take your active interest in the management of the companies. It not only gives you monetary benefit, but I told you it can give you expertise in terms of management, it can give you expertise in terms of technical, right? Or it can give you the services of a banker, stock market, or entrepreneur together. So it is not only giving you monetary benefit, but it is also making you participate in the management related activities. It helps you in achieving something called as social objectives. Venture capital financing, right, is different from development funds which are provided by state or central governments, right? Venture capital projects are those which help you in generating employment, which tries to bring the balanced regional growth or balanced regional development, right? Indirectly by setting up new companies. So it is not financing the normal firms, it is financing those companies which have a perspective of getting long term returns or growing at a very rapid pace. Not only that, it will give you investment, right, which is not liquid, right? It is long term. I told you, it gives you capital gains, or it gives you long term gains, but not short term. So venture capital is not subject to repayment on demand, right? It is realized only when the company is sold, or when it achieves something called as stock market listing. Only then you can get your investment back. So it is, see, company, it venture capital financing can only be got back, or venture capital financing can only be earned when the company is lost, and when it goes into liquidation. Now, whenever we are talking about venture capital, there are different types of venture capital. Generally, when we are talking about organized, or when we are talking about institutional venture capitals, there are three types of venture capitals. First one is venture capital funds, which are called as VCFs. These are set up by something called as angel investors, right? That is, they are the people who are called as high net worth individuals, right? Those kind of investors can only give you something called as venture capital funds. The second one is venture capital subsidiaries of corporations. These are actually established by major companies, or these are actually established by commercial banks, right? Or holding companies, or other financial institutions. Next, you have something called as private capital firm or private capital funds. The primary institutional source of venture capital is venture capital funds, right? Because venture capitalists take high amount of risk by investing in something called as early stage companies. These are the companies which have no history. These are the companies which have little history, and they expect to high rate of return, or they expect high risky investments in which the returns are very high. Now, whenever we are talking about venture capital is something, right, where the funding takes place in the following manner. Whenever you're talking about venture capital funding goes through various stages, right, through which funding happens. These stages are divided into 4 stages. The first stage is submission of plan by entrepreneur to venture capital. See, whichever company wants to acquire funds, or whichever company wants to acquire the capital, the funding process starts with the submission of the plan of that entrepreneur to the venture capital institution, right? Now, whenever I'm talking about plan, we are talking about a business plan which helps to convey to venture capitalist the business idea, the market. I mean, what is the market conditions? What is a business idea? What are they intending to sell? How are they planning to make the profits? Right? How do they want to grow the business? The detailed information, all the required detailed information is submitted in the form of a business plan, which has details pertaining to executive summary of the proposal, what is the market size, information pertaining to management, what are the budgetary requirements. Everything is detailedly provided in the first stage in business plan. Once the business plan is submitted, the second step is first meeting among the parties. See, venture capital institution, once it receives the business plan from the entrepreneur, the next thing that they do is they hold a meeting among the parties, right? First, they go through the entire business plan, right? And the venture capital institutions call for something called as a face-to-face meeting with the management of the startups. This is the first meeting with the management. So this meeting is very important, because at this stage, it is decided whether the venture capital institutions will invest in that kind of business or not. If everything goes off well, that is, if they are satisfied with the information provided by the parties, they will go to the next stage, that is conducting due diligence. Now, conducting due diligence is the third stage. It is a process in which you are quickly evaluating the references given by business owners about their customers, about their business evaluation, about their debtors, creditors, right? So you are getting relevant information and you are checking whether that information is correct or not. Due diligence is done under third stage. And the fourth stage is finalizing the term sheet, right? If everything is done, if you're satisfied with the business plan, if you're satisfied with the budgetary requirements, if you're satisfied with the what do you call as with the meeting that is conducted from the parties, right? And under due inspection or under due evaluation, if you find everything is satisfactory, you prepare something called as a term sheet. Term sheet is nothing but a document. It's a non-binding document which takes into consideration the terms and conditions that will happen in this venture capital between the two parties. So whenever we are talking about the term sheet, it is negotiable, in the sense both the parties can sit together, decide the terms and conditions, and it is finalized only if all the parties agree to it. Once the parties agree to it, all the legal documents are prepared, everybody signs it, and it will become a formal document, or it will become something called as a formal agreement between the venture capital company and the entrepreneurs. Now, next comes what is a role of what do you call as venture capitalist in 1 second. What is the role of venture capitalist, right? See, the venture capitalist plays a very important role for the startup entrepreneurs of the product and the economy, and it goes on. See, one of the important role that the venture capitalists play is they promote entrepreneurs, or they promote something called as entrepreneurship, right? See, entrepreneur is one who converts his technical know-how into something called as a commercially viable project, right? And that's the reason venture capital, by providing funds, or venture capital by providing capital requirements, promotes entrepreneurship among people. Not only that, they promote the products also, new products with modern technology, right? Those kind of products or those kind of promotions are made by the venture capitalist. they do something called as holistic encouragement, right? They not only provide the capital, I told you, they not only give you financial assistance, they will also assist you in technical, managerial, or marketing activities also. So they bring a holistic encouragement to the company, they bring a holistic environment in the company. They don't only give you capital, or they don't only give you funds, but they also give you managerial or technical expertise knowledge also, right? Not only that, venture capital also ignites the latest talent. In the sense, see, while funding entrepreneurs, the venture capital institutions also give what do you call as more trust to the talent of the borrower, right? Which helps them in growing, or which helps them in borrowing. So they will also see the talent of the employee or talent of the entrepreneurs before sanctioning up the funds. They also promote something called as exports. They not only encourage this funding in only domestic workspace, but they also plan to export it in the foreign countries also. By promoting entrepreneurship, venture capital institutions are also encouraging something called as self-employment, or they are creating more employment, motivating people in order to establish venture capital, in order to establish startups or entrepreneurships. That is one thing. Not only that, they also create something called as financial stability, right? Through their assistance in terms of money, in terms of marketing, in terms of management, the venture capital institutions make sure that they bring some kind of financial stability. They bring some time, they bring some kind of financial viability. They bring some kind of financial viability also when it comes to venture capital. So they strengthen the capital market also by providing something called as financial or technical assistance. Not only that, they help something called as sick companies. Many sick companies are unable to turn around because they are not getting proper capital, or because they are not getting proper encouragement from the other institutions. So venture capital also helps you out in bringing that sick companies into a revival stage, or bringing that sick companies into the survival stage, which is very, very important role. Now, there are different stages of funding. The stages of funding in venture capital uh, is differentiated in venture capital industry. The stages of funding is divided into two categories: early stage of financing or early stage of funding, and the latter stage of financing and latter stage of funding. In the early stage of financing, it again includes, or it is again further classified into three. You have something called as seed capital or pre-startup. You have something called as startup. You have something called as second round financing. Now, when you're talking about seed capital stage, right? What happens in seed capital stages? This is a phase, right? Wherein the company is gradually moving towards the development phase, like leading to something called as prototype product testing, or planning to commercialize the product, right? In that stage, when the financing is provided, we call it a seed capital stage. It is actually the phase in which you are creating concepts, you are creating ideas, right, as a promoters, and it is the basis for pre-commercialization of any product. So the main risk at this stage is something which is related to marketing, right? Here the marketing costs are very, very high, because you have to create a kind of awareness, you have to create a kind of what do you call as competition for your product. Next comes the startup stage of financing. This is a stage when commercial manufacturing takes place. This is a stage where venture capital financing is provided for product development. Now, coming to second round financing. In second round financing, this represents the stage at which the product has already been launched into the market, or this represents a stage at which, right, wherein the product is commercialized, right? It is not becoming profitable, but it is attracting new investors through issue of public shares. In such stage, you can go for second round of financing. Next comes the later stage of financing. In later stage of financing, venture capital establishes financing for something called as development capital, bridge and expansion capital, buyout capital, and turnaround capitals. Now, whenever you're talking about development capitals, right, where you are contributing capital to finance the development stage, which is between 1 to 3 years, right? Or whenever you are talking about when it is a stage which has extremely high risk, right? You are recording profits for few years, but yet to reach a stage where you have to go to public, or you have to raise money from capital market or conventional sources. This is a development stage, because here the company starts earning more and more amount of profits. Next comes bridge and expansion phase, right? It includes a time frame of 1 to 2 years, right? Where the risk perception is low. This here you require money to expand your business operations, to increase your productivity, to increase your what do you call us, to acquire the assets. You require money for that. You take something called as bridge and expansion capital. There is something called as buyouts, right? Wherein you are transferring the management control, right? There's something called as management buyouts, and there's something called as management buy-ins. In management buyouts, what happens is venture capital institutions provide funds to the current operating management investors, whereas in buy-in, right, they provide capital to enable the outside group of managers to buy the ongoing company, right? Apart from that, there's something called as turnarounds. They are it is a form of venture capital financing which involves medium amount of risk. The time period or the time frame can range from 3 to 5 years, right? They use two types of inputs, namely money and management, in order to provide the venture capital. Now, whenever we are talking about the advantages and disadvantages of venture capital, the advantages of venture capital is, see, one of the greatest advantage with venture capital is they provide an opportunity for expansion, right? The venture capital provides company with an opportunity to expand. This would not be possible with other methods like bank loans, because whenever you go for a bank loan, you have to put something in the form of collateral security. There is an obligation to repay the loan, right? Whereas in venture capital, the investors are ready to take the risk. They believe in the company's long-term success. They don't ask you anything in the form of collateral security. So it gives you an option for expanding your business operation. Second thing is it gives you valuable guidance and expertise. They not only provide you financing, they not only provide you capital, but they also provide you valuable services in terms of guidance, in terms of expertise, and in terms of consultation, right? A member from the venture capital institution is appointed on the board of the startup company. So what happens? It involves active involvement of venture capitalists in the company's decisions. So whatever decisions you take, that board member will be involved in each and every decisions, wherein he will provide his guidance, he will provide his technical expertise, or he will provide his what do you call as valuable advices wherever required. Not only that, venture capital is helpful in building networks and connections also, right? See, the venture capital financing or venture capitalists have a very huge network of connectivities, because they will deal with all kind of startups. They deal with all kind of what do you call as entrepreneurs. So these connections could be advantageous for the startups. They can help them grow, they can help them in being successful, right? They can help them in getting up new alliances with potential customers or business houses. So they will help, venture capitalists will help the businesses in building networks and connectivity. And one of the greatest advantage with venture capital is no obligation for repayment, right? If the startup fails or if the startup shutdowns, there is no obligation on the part of the company to repay the amount. So venture capital is generally funding the startup, so it does not leave the startup with the burden of paying up. No, they, if it works out, they might go for an equity requirement, but they will not ask you to pay up the amount. Not only that, venture capitals are trustworthy, right? Because venture capitals are strictly regulated by the regulatory bodies. For example, in India, SEBI regulates the venture capitalist. So because they are under the close supervision, or because they are under the complete supervision of the venture capitalist, right, they are trustworthy. They are not what you call as fraud. They are not fraud. They are not conducting any kind of fraudulent activities when it comes to venture capital. And they are easy to locate. See, you can find venture capitals. It reduces your time, it reduces your efforts, it reduces your money, right, which is involved in searching venture funding, right? Because you can find easily the venture capital funds. If you if you can get a huge list of venture capital firms by typing venture capital in any of the search engines, which is Yahoo, Google, wherever you type about venture capitalists, you get a huge list, right? Followed by it. But there are some drawbacks also of venture capital. Whenever we are talking about the disadvantages, they don't ask you to pay back the money, but they ask for dilution of ownership and control. They are not only providing you financing, but they are also providing you managerial and technical advice also. So venture capital involves, right, stake in equity, or venture capital involves ownership rights, right? So your ownership or your equity is diluted under venture capital, right? Not only that, early redemption by venture capital institutions. They ask you to redeem the investment within 3 to 5 years. Their major focus is on capital gains. They are suitable for entrepreneurs whose business plan will take longer time, right, in order to provide them liquidity. Not only that, the venture capital link process is long and complicated, right? Because I told you it goes through various stages. First, you have to submit a detailed business plan. Then you have to analyze the business plan in detail. Then there would be a meeting with the what do you call as the venture capital people. Then a due diligence will be conducted. Then only if things are finalized, a term sheet will be prepared. So it takes a long and complicated process, right? Not only that, venture capital institutions take a long time to decide whether to invest into a particular startup or not, right? It may require high return on original investment, right? Because they want their return back in 3 to 5 years of investment, right? If the startup needs more time to generate high return, they might, I mean, opting for venture capital might not be the right choice. So it high return on investment causes high level of stress also, right? And they will release funds from time to time, because venture capital funding involves huge amount of capital, right? They cannot release all funds at the same time. So they will provide you funds, or they will release you funds from time to time, right, whenever required. And they may lead to undervaluation also, right? See, whenever there is a pressure of the ownership in the list of the company, right, the listing could also result in undervaluation of the company share also. That also turns out to be a biggest disadvantage with venture capital. Now, after venture capital, there is something called as concept of leasing. See, whenever we are talking about leasing, or whenever we are talking about lease, right, it is also one of the financial service which is provided by the financial sector, or which is provided by the financial industry. Now, what is, see, the main objective of any business organization is not only earning profit, but also maximizing the shareholders' wealth, right? So for maximizing the shareholders' wealth, every company tries to identify attractive projects, right? And the firm also considers various methods of financing. So it not only takes into consideration debt or equity financing, leasing is also chosen as one of the source of financing, right? Which is used by many business houses in order to what do you call as maximize their shareholders wealth. Now, here comes the question, what does lease mean? See, a lease is a written document, or a lease is an implied agreement which specifies the conditions, right? There are certain conditions upon which a person called as leaser accepts to let out his property to be used by leasee. Say there are two people. One is called as the leaser and the second one is called as a leasee. Leaser has some property and leasee wants to use that property. Now, under what circumstances leasee can use that property? Under what circumstances leasee can use that property? That circumstances, that terms and conditions, when written on a document, it will become a contract of lease. Now, lease is a form of contract where you are transferring the use or the occupancy of a land, space, or structure, or an equipment, right, for some consideration. That is, when some party is making some payment of fees, when some party is making some payment of, right, you are agreeing to transfer the right to use that property. You are agreeing to transfer the right to use that, occupy that land, right, in the form of what do you call as lease, for which the leasee will be paying the rent. So the agreement which promises the leasee that he can use a certain property for an agreed length of time, right? By paying constant payments to the owner over an agreed period of time, such kind of agreement or such kind of contract is called as leasing. Now, the leased property here is called as the demised property or asset, right? Both the parties are bound by the terms and conditions of the agreement, right? Now, the owner of the asset is called as the leaser, and the user of the asset is called as leasee. There is a periodical payment that a leasee has to make to the leaser, that is called as the lease rental or the lease rent. So, under what happens under leasing? Leasee is given a right to use the asset of the leaser. He is only given the right to use the asset, but he is not the owner. The ownership still lies with the leaser only, right? At the end of the leasing contract, the asset is to be returned to the leaser, right? uh, or it can be purchased or it can be renewed according to the agreement of lease. Now, there are certain essential elements of lease. Now, what are those essential elements of leases? See, there are two parties involved to a lease agreement. One is called as the leaser and the second one is called as the leasee. Leaser is the landowner, leasee is the tenant, leaser is the owner of the equipment, leasee is the user of the agreement. And there is something called as an asset. Asset is a subject matter of the lease agreement. That is, it can either be a movable or immovable property, right? It can be a piece of land, it can be a house, it can be a what do you call as a right to collect a food from gardens, it is a right to extract oils or from mines, right? It is a right to fisheries or any kind of thing. So whenever one person gives him a right to another person, that becomes a contract of lease. Duration of lease, see, in lease agreement, the right is not transferred forever. The right is transferred for a specific time duration. The right is transferred for a specific time period. So that duration of lease must be specifically or clearly mentioned in the lease agreement, and there should be some consideration in the sense there is some premium, there is some rent paid by the leasee to the leaser for the use of the property or for the use of the asset. And there can be sometimes something called a sublease. That is when a leasee transfers whole or a part of a interest to another person. It is called as sublease. However, this is subject to, right, the contract. It is subject to transferring the lease. Everything should be done in proper coordination with the leaser. Now, whenever you're talking about the lease, there are different types of lease, right? We have something called as operating or service lease. We have something called as financial lease. We have something called as other types of lease, right? Whenever you're talking about operating lease, it is a short-term lease or a contract in which the leasee agrees to rent an asset from the leaser, right? Or attain the rights of ownership. Like, it is suitable for things like computers, copy machines, office equipments, material handling equipment, right? Which are very sensitive to obsolescence, right? They are usually short term. They are usually of short notice, right? They are something which can be a service provided to a customer like maintenance, insurance, right? Because they are short term, the risk involved is also very less, right? On the leaser and the leasee also, the risk involved is very, very less. Next comes finance or capital lease. In this lease agreement, the leasee retains the possession of a leased asset or equipment even after the period expires. Then such type of lease is called as finance lease. See, this is very common with, or this is very suitable to high cost equipments like office equipment, diesel generators, machine tools, right? Textile machinery, containers, locomotives, right? So whenever you're talking about financial lease, when you are using the asset even after the time periods, we call it as capital lease or financial lease. It has different features like present value. It has something called as time period. It has something called as termination. All these are the features of what do you call as financial lease. Then when it comes to other types of lease, there are some other types of lease also. For example, floating rental lease contracts, right? Frequent change in interest rates, Domestic lease and international lease. When the equipment is leased within the same country, we call it as domestic lease. When the agreement is leased to an outside country, we call it as an international lease. There is something called as sale aid leasing, right? Wherein you are entering into an agreement with the seller, right? Who is usually the manufacturer of the equipment, right? That you will lease his operations. Apart from that, we have something called as foreign to foreign lease, right? Here in leasing agreement, there are three parties involved. One is a manufacturer, that happens in one country. The leaser is from another country, and the leasee is from third country. See, for example, China is a manufacturing country. It exports machinery to India, right? Which further sells it or leases it to Australia. So generally in lease agreement, there are two parties involved, but foreign to foreign lease agreement, we have three parties involved. Now, what are the advantages with leasing is it avoids you an opportunity of initial cash outlay. You can get 100% financing from lease financing. So you need not worry about that initial cash outlay. There is something called as a minimum delay only, right? I mean, the time taken for leasing contracts is much lesser when you compare it with venture capital financing or any other long term financing. And it is an easy source of financing, right? Because it does not require any kind of mortgage of assets, or it does not require or changing of ownership, things like that. So it is very easy of financing. The shifting the risk of obsolescence, right? Girls, see, whenever we are talking about today's changing technologies, the risk of obsolescence is very high when it comes to today's technology driven environment. So here the shifting of risk of obsolescence is made to the leasee rather than keeping it with the leaser. And enhanced liquidity, because it involves sale, leaseback of assets and things like that. It will enhance something called as liquidity. But at the same time, it will give you an option of convenience and flexibility, right? You can terminate the contract if you don't feel it is comfortable, right? You can be more flexible with your contract and things like that. But there are some disadvantages also. It requires high cost, right? See, you are bearing the risk of depriving the use of asset. You cannot make changes into the asset, right? There is loss of ownership, right? There are penalties if you terminate the lease contract and things like that. So it includes a lot of disadvantages also. Now, coming to the next thing, we have something called as hire purchase. Now, whenever we are talking about hire purchase is an agreement, is a method of financing fixed assets that have to be purchased at a future date. See what happens. The important way in which you can sell goods is either you can sell it on cash or you can sell it on credit. If you're selling it on cash, the buyer purchases the goods and services and immediately makes the cash payment. But if you are purchasing it on sales, right, you will not get the money immediately, right? Ownership is transferred from seller to buyer immediately, but the price is not paid immediately. So these traditional method of sales, right, one more method is added, that is called as hire purchase system. Now what happens in hire purchase system is the purchase price is paid in installments. Ownership of the asset is transferred after the payment of last installment. See what happens in hire purchase. A hire purchaser becomes the owner of the asset only after making the last payment. Every installment should be treated as a hire charge for using the asset. Whatever till last installment, whenever he pays the installment, they have to be viewed as a hire charge, right? Hire purchaser can use the asset right after making the agreement with the hire vendor. You can use the asset immediately after making the agreement, and you have a right to repossess the asset in case of difficulties in obtaining the payment of installment. You can get your asset back, or you can get your, what do you call as, you can get your ownership back if the installment is not paid on time. Now, there are a lot of conveniences with the hire purchase. It is convenient to make the payment in hire purchase. It will help you in increasing your sales volume. It will help you in increasing your profits. It will encourage something called as a habit of saving in investors. It would be helpful for small traders, They help you in earning interest, right? And they are lesser riskier when compared with the other things. But at the same time, there are some disadvantages also. They charge high price, right? Whatever is the buyer charging, the price at which the buyer is charging is very, very high. They create something called as an artificial demand for the product, right? Which tempts the buyer to purchase the products. It is heavily risky under the system. The seller is at heavy risk, right? Not only that, the seller does not get the installments from the purchasers on time, right? Sometimes they might choose wrong buyers, which might put them into trouble, right? They have to waste their time and things like that. So it is difficult to recover the installments and breakup of families. This system puts a financial burden on the families which cannot afford to buy costly and luxurious items. So they break up the families because of the system that they are with which they are working with. And the next one is something called as installment system. See, the installment payment system is also one of the system wherein the buyer is given the ownership as well as the possession of the goods at the time of signing the contract. See, the installment system is also like a credit system of purchasing or selling goods in which payments and receipts are made in installment basis. We might have heard about the concept called as EMI, easy monthly installments, right? What happens in that? You pay a certain amount of money as down payment at the time of signing the agreement. The remaining amount can be paid in periodical intervals, such as you can pay them monthly, half yearly, or annually, depending upon the agreement, right? In this system, the purchaser gets both the possession as well as also the ownership rights of the goods. It is just like you're buying some good, not making the payment immediately and promise to pay the payment in EMI options, right? If purchaser fails to pay any of the installment amount, the vendor cannot repossess the goods because the amount already paid in installment by the purchaser cannot be forfeited, right? Now what happens in installment payment system, right? Buyer is given the all rights like ownership rights. Buyer is given the possession of goods right at the time of signing the contract only. So the buyer has the facility to pay the remaining amount. See, they pay some portion of amount as down payment. The remaining portion is paid in the form of EMI. Now, under installment purchase system, right, there is an agreement to purchase or pay the installment for goods which become the property of the purchaser immediately when he receives it at the time of delivery, right? Now, there are some features of installment purchase system. When you're talking about the features of installment purchase system is just like outright credit of sales. Just like you sell goods on credit, installment purchase system is also the same system. The buyer makes the payment in separate installments periodically over an agreed period of time. See, EMI option, you make the payment periodically every month and you pay it, right, up to the agreed time period and things like that. Under installment purchase system, the buyer gets the immediate possession of both goods and also the ownership. The seller cannot repossess the goods if the buyer defaults in payment, but you can sue against him under the court of law. In case of default in payment of installment, the number of installments already paid by the buyer cannot be forfeited or cannot be suspended. And under installment system, the buyer can sell or mortgage the goods even before clearing all the installments. See, if I have taken a good from you on credit basis, I'm making you the payment. I need not wait for the entire payments to be done in order to forfeit my goods. I can do it before making all the payments also. The buyer of the goods under installment purchase system has no right to return the goods to the seller. You, as a buyer, you have no right to return the goods to the seller. Now, not only that, whenever you're talking about the installment system, right? Under installment system, there are a lot of advantages. There's a lot of advantages and few disadvantages also. Now, talking about the advantages of installment purchase system, the installment scheme helps the buyers to buy goods which are beyond their reach. See, purchasing power of people vary from one individual to another individual. So this installment purchase system gives an option to buy goods which people cannot invest upon or which people cannot afford upon. Not only that, it will enable the business to find buyers for their products. right? Business cannot always find cash parties for products because they're very expensive. So sometimes they have to sell their goods on credit also. Next, it helps the finance companies to develop their businesses, right? They nowadays finance companies finance several articles, right, under installment system. So it helps the business houses to expand their business operations. Not only convenience, luxury items are also sold under installment systems, which will help in increasing the living standard of the people. Sellers can increase their sales under the installment system are more profitable rather than the cash systems. And these days most of the business houses are coming up with number of offers. They're coming up with something called as free gifts. They're coming up with something called as buy one and get one options, right? All these are, right, exclusively happening under installment purchase system only. But there are some disadvantages also. Installment system, right, tempts the buyer to buy the goods which are not required, which are actually luxurious but not comforts. Now installment purchase prices are much higher than the cash prices because they include something called as interest. The rate of interest is very high, so the price of the commodity goes up when you are buying products under installment systems. See, the important thing in financial system is savings, but under installment systems, right, you are making people spend money rather than saving. Now whenever we are talking about installment system, agreement can be entered into and guarantee can be given. More legal formalities can be followed under installment systems, whereas at the same time the rate of default is also very high. It is because only few people have an adequate means to pay off the money under the system. The remaining turn out to be as non-payers, which is again the biggest problem with what do you call as installment systems. Not only that, we have something called as what do you call as factoring and forfeituring. Now whenever we are talking about factoring is something, right, where whenever we are talking about factoring, see, every company requires certain free flow of working capital for the smooth functioning of business. So in order to purchase goods, services, right, which often delays the payment, right, then banks are approached upon in order to provide something called as working capital credit to their business firms. Because they are unable to meet their working capital requirements by themselves, they are approaching the banks. So one of the financial service which can be used to help the business houses to arrange payments for their receivables in a better manner is factoring. Now what happens in factoring is an agreement, right? Factoring is a relationship that is built between a buyer of the goods and the financial institutions, which is called as factors, whereby the latter purchases the receivables of the former. In a sense, the financial institutions purchase the bills receivables of the company, right? Controls them and administers them according to the requirement. The term factoring is defined in different countries in different manner, right? Now, whenever we are talking about factoring, how does it work is, see, selling company and the factor company enter into an agreement. The agreement provides a basis or scope of understanding between these two companies, right? The document contains a series of instructions to make the payment directly to the factor company, right? Henceforth the company will not think about its receivables, the factoring company will think about its receivables. Not only that, the factory company pays substantial portion of accounts immediately after the sale. When the payment is received by the factor, the account of selling firm is credited by the factor after deducting the fees, interest charge as agreed upon. So factoring works like, see, if I have some bills of exchange, right, and I cannot maintain them properly, so I discount it with a company which helps me out in factoring. Now there are different types of factoring with which we work upon. We have something called as recourse and non-recourse factoring. We have something called as advance and maturity factoring. We have something called as conventional or full factoring, domestic and export factoring, disclosed and undisclosed factoring, right? See, these are the different types of factoring services that are provided. Now, see, whenever we are talking about factoring, It makes sure that the cash flows from the credit services. It serves as a short-term finance. It ensures better management of receivables because the factoring services provided company is specialized agency for doing so, right? It saves cost. It helps in advisory services. Credit information can be analyzed by the factoring company, right? And it saves the time and management of the time and money of the management under factoring. But when you're talking about disadvantages, factoring has high cost when compared with the other sources of short-term financing, right? Factoring may lead to overconfidence in the behavior of the client, which will result in mistrading or overtrading, right? Adverse efforts are there. There is lack of professionalism and competencies. There are people who have not developed properly or who are resistant to change under factoring. Not only that, we have something called as forfeitoring. Now, forfeitoring is also one of the financial service that is provided, right? One of the financial services that is provided. What happens in forfeitoring is, see, whenever you're talking about forfeitoring can be defined as a non-recourse purchase by a banker, right? Now, what does forfeitoring means is, see, it will enable exporters to receive immediate cash by selling their medium and long-term receivables, right? And the amount an importer owns the exporter at a discount through an intermediary. See, it eliminates the risk of making sale of receivables within the recourse. It has no liability regarding the importer's possible default on the receivables. Now, whenever you're talking about forfeiting, there are five parties to forfeiting: exporter, importer, importer's banker, and forfeiter. See, I have a bills of exchange. I want to exchange it, or I want to sell it off. The forfeiting company will buy it, right? For me, for which I need to have an importer, I need to have an exporter, I need to have an exporter banker, I need to have an importer banker, and I need to have something called as a forfeiter who will be helping me out in doing all these things. Now, there are different types of forfeitings. What are the different types of forfeitings is, you have something called as bill of exchange or promissory note, which can act as a forfeiting. See, whenever we are talking about forfeiting, the majority of the obligation comes from bills of exchange, or the majority of the forfeiting comes from promissory note. Not only that, it is without a recourse costs. Whenever we are talking about without recourse clause, see, by transferring the bill of exchange, or by transferring the promissory note, or by transferring the drafts, the exporter transfers his claim to the forfeiture, which can be done by endorsement, right? Like, you can please pay the order of forfeiture while not recourse. So that can be one thing. Effective or net of reduction clause. All the drafts clearly bear this clause, which makes sure that the payment is done only in currency agreed upon, right? Not in local currency, in whatever currency you have agreed upon. That can be the effective or net of reduction clause. And there's something called as letters of credit, right? When deferred payment, these letters of credit can be used. There are some other services also provided under things like custodial services. This is also one of the service which is provided under financial services. Whenever we are talking about custodial services, right? Custodial services are the services which are provided provided by an investor, right? Who places to store assets with safety. See, for example, bank can give you custodial services. They give you something called as safe deposit lockers, wherein they plan to save your assets, wherein they plan to save your documents, right? Or they promise you that these documents will be kept safely. So it reduces the risk on the client of losing their assets or having stolen their assets. They provide a wide range of services like safekeeping and settlements. They collect dividends on behalf of you. Not only that, they go for distribution, they go for proxy voting in case of what do you call as voting services. They give you administrative services. They give you something called as fund administration. They provide you market news. They provide you competitors information and things like that. See, for example, the services provided by Kotak Mahindra, right, is the best example for it. Is called as the Kotak Mahindra Bank Limited's custodial services. They offer this wide range of services to their customers. It is actually a bank, Kotak Mahindra. I think all of you know Kotak Mahindra Bank Limited. These are the custodian services provided by the Kotak Mahindra Bank Limited. It provides you services like account opening, right? Safekeeping or depository services. They provide you corporate action event services. They provide you foreign exchange services. They provide you proxy services, proxy voting services. They provide you compliance monitoring and reporting services. They provide you something called as transaction settlement services. They provide you something called as standardized and customized reporting services. So when huge number of services are provided under a single domain, we call such kind of services as custodian services. Next, we have something called as a depository services. See, whenever we are talking about the depository services, Indian stock exchanges are was very inefficient, very risky, right? Because the time that elapsed before trades were settled. So the transfer was by physical movement of papers. There was physical delivery of securities, right? And the second aspect of settlement relates to transfer of shares in favor of the purchaser. So the system of transfer of ownership was grossly inefficient. So in order to make it paperless, in order to make it what do you call as things, right, there's something called as depository services which has been come into existence. Depository services are originated recently in Indian stock market, right? Presently online trading or scriptless trading or paperless trading in shares of any company is mandatory. So you cannot go for a physical trading option. You can only go for something called as an online trading option. Depository service is a mechanism which makes the online trading possible. Now, how does it work? Depository services are the services in which securities of the investors are kept in an electronic form rather than in a paper form, right? Just like you maintain cash in your bank account, uh, which provides all the services of cash, depository services also provides information pertaining to all the securities like your buying and selling of shares and things like that, but they keep them in an electronic form rather than something called as a physical form. Depositories helps the customers to perform out the transactions related to the securities through something called as demat account, right? Through this system, the transfer of ownership takes place by the way of book entry rather than physical transfer of shares. When a person wants to deal in shares with any of the company, he can open this demat account with the depositories through a depository repository system. Now, what happens under depository system is, see, this is how a dematerialization process goes on. See, in depository system, you have to open something called as a demat account. There are parties which are involved. There are certain securities in dematerialized form. There is no stamp duty which is required. They are freely transferable from one person to other person. Now, what happens in dematerialization is, see, whenever you are talking about the dematerialization, it is a process by which physical shares, securities of an investor are taken by the company and an equal number of securities are credited in the form of an electronic system. See, instead of maintaining, I told you today, if you want to buy and sell of any shares, you have to go in an electronic form only. You cannot go in a physical form. So this dematerialization, in dematerialization process, physical shares are taken from you and the shares are given in the form of an electronic format. Why? Because it is safe, it is secure, and it is very convenient way of buying and selling or transacting with stocks without the trouble of paperwork or delays, because paper can be lost, paper can be damaged and things like that. But when you maintain things in an electronic format, it will not. So it is a process which works in this way, in which an investor surrenders his physical security or physical certificates the to something called as dematerialization, right? The DP informs the depository about the request, right? DP submits the certificates to the registrar of the insurance company. The registrar communicates with the depository to confirm the request. Dematerialization of the certificate is done by the registrar. Accounts are updated by the registrar and the repository informed about the completion of the dematerializations. Accounts are updated by the depository and the DP is informed about the same. Demat account of the investor is updated by the DP. So you see, there are a lot of advantages when you go for dematerialization rather than holding a physical shares. There would be elimination of risk. There would be elimination of bad deliveries. Transfer can be done immediately because this paperless or better scriptless. Faster settlement cycles, improves your implementation, right? It waivers your stamp duty. There it has ease of portfolio monitoring. It has ease to change the addresses and things like that. But you can also go for rematerialization. You For rematerialization you have to go in a reverse order of dematerialization. So this depository system has comes with a lot of advantages. One thing is it is paperless, it is scriptless, so you can transfer funds and securities quickly. It eliminates all the risk of physical handling of securities like loss in transit, theft, counterfeiting, mutilations. Everything can go. It eliminates the payment of stamp duty. It provides you insurance coverage. It settles the accounts periodically. It transfers the non-cash benefits. It reduces the settlement cycle to the investors. It reduces the brokerage charges also, right? It reduces something called as bad delivery. It provides less risk and it avoids cross-checking of shares, deeds, and other papers. But there are some disadvantages also, right? It may lead to increased number of online frauds because there is no physical checking or there are no physical securities in hand. There would be a coordination problem because of multiple repository systems, right? Not only that, they require greater supervision over market players because dematerialized securities such as stockbrokers, they need what do you call as they need to be supervised as they have capability to be manipulated in the market. So there are some disadvantages also of what do you call as dematerialization systems, or there are some challenges also that exist in the depository system in anywhere in the country. So whenever you are talking about the Indian financial systems, it not only provides you services like lease, hire purchasing, factoring, forfeiting, dematerialization, depository services, but it also provides you other services like housing loans. It provides you with various types of home loans like home purchase loans, home constructions loan, home expansion loans, home improvement loans, home conversion loans, NRI home loans, balance transfer loans, stamp duty loans, bridges loans, land purchase loans. It provides with various types of loans. Not only that, they will also provide you with something called as plastic cards, right? These plastic cards come with convenience. This plastic come with safety to the customers, right? It is a card which is issued by the bank to its customer to perform more number of services related to customer account, right? A bank card has a client name, issuer name, and a unique number. This card contains something called as a magnetic strip which will help you to use various services of provided by various machines. So like you have debit card, you have something called as credit card, you have something called as a what do you call as ATM card. All these cards are plastic cards. So you have something called as a fleet card, gift card, and things like that. So there are a lot of other services also which are provided by Indian financial system. So whenever you are writing about Indian financial sector, you need to write about something called as see, from an examination perspective, whenever you're writing about Indian financial system, you need to learn about Indian financial system as an overview. You need to learn about in financial system. You need to write about Indian financial markets. Like you need to write about capital markets, money market, foreign exchange markets, derivatives market, and commodities market. You need to write about financial services like banking services, financial insurance services, merchant banking, mutual funds, credit rating agencies. You need to write about services like leasing, hire purchasing, installment system, factoring system, forfeiting system, custodial services, and other services. All these are very, very important when it comes to Indian financial system or Indian financial structure. Right? Thank you.